Today, we are breaking down a geopolitical crisis with the power to completely reshape the global economy. We're talking about the war in Iran and what it means for the stock market. Potentially, its final warning.
You know, this one sentence from a recent intelligence brief just perfectly captures the knife's edge we're all on. A thin membrane. That is literally all that stands between a contained conflict and a full-blown global economic crisis.
Right now, Wall Street might be just one single headline away from a violent repricing. Think about it. Oil explodes, inflation comes roaring back, bond yields reset, and U.S. stocks are right in the line of fire. So look, the question is no longer if risk is rising, that's a given. The real question is, what happens when a market that's been asleep at the wheel is suddenly forced to wake up?
So in this explainer, we're going to cover how this war kicked off, the most probable scenarios from here, and the forecast for stocks. We'll also dig into the global oil shock, what the market seems to be missing, and finally a crisis dashboard to help you navigate all of it.
So how in the world did we get here so fast? Well, the first 72 hours of what's been called Operation Epic Fury delivered a strategic shock that's really unlike anything we've seen this century.
The speed was just breathtaking. On February 28th, the U.S. and Israel launched this massive air campaign. Within 48 hours, they hit over 1,200 targets. And then reports confirm Iran's supreme leader and his entire defense council were killed in a decapitation strike. By March 2nd, Iran retaliates by closing the world's most critical oil choke point, the Strait of Hormuz. And by March 3rd, the conflict spreads. Hezbollah attacks Israel, triggering a ground invasion of Lebanon. The entire region is on fire. Okay, so where does this all go from here? In a crisis this fluid, a simple forecast is pretty useless. What you really need is a framework. So let's look at the probability-weighted scenarios that are going to define what happens next. Now, what's really interesting here is how this frames the odds. Intelligence assessments are putting the base case at a 55% probability of a brutal but contained proxy war. But look at that tail risk. A 35% chance of a full escalation, one that involves a sustained closure of the Strait of Hormuz. A fast de-escalation? That's a distant 10% possibility. What this means is the market is facing a very real, very fat tail risk, and that is a dangerous setup. And this slide really illustrates the two extremes. The escalation case gets triggered by what intelligence is calling a de facto military junta taking over in Iran. Think operational commanders who are optimized for tactical revenge, not for strategic thinking. They mine the strait or they hit Saudi oil fields, and just like that, we have a global crisis. The de-escalation case, on the other hand, really relies on a swift internal collapse of this new leadership, which would allow the U.S. to achieve its goals within its stated 4 to 5 week window. Okay, let's bring all this back to the market. What does this actually mean for the S&P 500? To do this right, we need to think across 4 different time horizons. So in the immediate 1 to 2 weeks, the bias is clearly bearish. Fear just takes over. We expect the VIX, the market's so-called fear gauge, to spike into the 30 to 40 range. Now, over the next 1 to 3 months, it's all about how long this lasts. If this conflict drags on past 4 to 6 weeks, the market will start pricing in a recession. Looking out 6 to 12 months, the whole narrative shifts to those second-order effects, things like persistent inflation and a hawkish Fed. And then finally, over 1 to 2 years, we'll see new structural winners emerge. Companies in AI-guided weapons, cybersecurity, and the energy transition. All right, let's talk about the main event, the primary way this war hits the global economy and, well, your wallet, the oil shock. So the most crucial point is really this single number. In that tail risk scenario we talked about where the Strait of Hormuz is closed for a prolonged period, we could see Brent crude prices shooting north of $150 a barrel. Let's be clear, a shock of that magnitude guarantees a global recession. And look, this isn't some fringe theory. Check out the consensus that's building on Wall Street. Goldman Sachs sees $120 to $150. JP Morgan and UBS are north of $120. And Deutsche Bank's worst-case scenario? It's approaching $200 a barrel. The risk of an extreme oil spike is very, very real. But, you know, the oil price itself is only the first domino to fall. There are hidden mechanics to this crisis, structural shocks that the market seems to be completely missing right now. This is what investors absolutely need to understand. The Strait of Hormuz isn't just being closed by Iranian gunboats. It's effectively being shut down by insurance underwriters in London. When the world's biggest marine insurers pull their war risk coverage, the strait just becomes a no-go zone. It's what we call an insurance blockade. a de facto closure that's just as effective as a physical one, and it can happen almost overnight. And it gets worse. For the first time in modern history, we are staring down the barrel of a dual choke point crisis. With the insurance blockade in Hormuz and Houthi rebels resuming attacks in the Suez Corridor, you have nearly a third of all global seaborne crude trade compromised at the exact same time. This is a completely unprecedented shock to global supply chains.
So with all this uncertainty flying around, what should you actually be watching? We've put together a crisis dashboard, the key signals that will tell you if we are escalating or de-escalating. We've distilled it down to the top 10. On the military front, you want to watch for Iranian submarine movements. That signals mine-laying risk, and any strikes on Saudi infrastructure. On the market side, the three major red flags are a sustained Brent crude price over $100, a 10-year Treasury yield, which sets borrowing costs for the whole economy, punching above 5%, and the VIX holding above 40. And geopolitically, the single most important sign of things cooling down would be the announcement of a new, more pragmatic leader in Iran.
All of this brings us to the ultimate question, the one on every single investor's mind. What is the most likely path forward from here? So let's put it all together in a simple scenario matrix. In the base case, a limited war, you're probably looking at a 5 to 10% correction in stocks, with oil hanging out between $80 and $100. Energy and defense stocks would be the winners. But in that tail risk scenario of a broader war, we likely enter a bear market of 20% or more, with oil spiking well above 120. In that kind of world, pretty much only cash and gold are safe. Okay, so based on all the available intelligence, the most likely path seems to be a brutal but contained conflict. It probably lasts 2 to 6 weeks. The stock market goes through a sharp correction, oil stays elevated, and the global economy just barely dodges a recession. But we absolutely cannot ignore that tail risk. That is the catastrophic path where this conflict escalates, the Strait of Hormuz is shut for months, oil skyrockets towards 150, and we are all plunged into a deep global recession and a very painful bear market for stocks.
So what's the key takeaway here? It's this. In times of crisis, a framework is so much more valuable than a forecast. Don't get caught up in the day-to-day headlines. Instead, understand the scenarios. Monitor the key indicators on your dashboard, and know how different asset classes are going to behave in each of those outcomes. That is how you navigate the fog of war.